I'm Ross
Exactly,
Weiner with
get out of the
Gemsco
picture.
Capital. Just real brief, a longtime real estate investment professional. Started out like everybody else, working for other companies. Went out and formed my own company, sort of mid-career, and have flexibility to invest in different kinds of principal investments for ourselves, for clients. We have some family office money. We have some other trust money and joint venture partners. We also act as advisors to others, particularly for transactions and capital advisory, and get involved in special situations and alternatives. And a couple of the panelists here I know well, and Kamil I just met, and it's going to be a real interesting discussion on what people do. Just as an overview, yesterday we heard about the macro environment, how challenging it is, and I know everybody's concerned about all the cross currents that we see in real estate with inflation and high interest rates, and wars in Europe, and potential tensions with China, and all kinds of disruptions that we have going on. And it's impacted the real estate market, particularly I think interest rates and cap rates. And that's caused transactions to grind to a halt in certain sectors. So traditionally, when most people think about real estate investing, they think about the big sectors: office, retail, industrial, hotel, residential. Today, we're going to talk about some things that are sort of a little bit outside of that. And I thought it was, as a start, I thought it was interesting today, just looking at the newspaper and the Wall Street Journal, that despite the macro, outlook that we talked about yesterday, we saw a 3% increase in retail spending was announced yesterday, which was the largest monthly gain in 2 years. So it shows that the consumer, despite everything, is still strong. And there was another article that talked about gambling revenue continues to climb, which also suggests that the consumer is still strong, unless people are trying to, win their monthly rental payments or mortgage payments or what have you. So with that as an overview, I'm going to introduce the panelists really quickly. Got Billy Haddad. Billy is with a family office called Partners Path, and they invest in a wide variety of assets, a lot of alternative investing, some traditional investing on behalf of some ultra high net worth individuals. Billy's a sharp Wharton guy himself. We have Mike Schneider. Mike is with a VC-backed startup called Acre Homes, which I'll tell you about, which has got a real innovative strategy and a twist on the single-family rental model, which involves a shared ownership concept, which is real interesting, and definitely not one of your traditional type real estate investments, but an interesting opportunity as we look out towards the future. And we have Kamil Homsi, who's a family office investor, and he invests primarily in alternatives, and he'll talk more about that himself. With that, Billy, turn it over to you. And what are you guys doing? What do you see as interesting areas of opportunity, despite what your concerns are with the current environment, and how you managing to do that?
Sure. So our main focus is multifamily investing traditionally, and so the buildings we own are performing well. Rents are up. I think in the last month or two we've started to see rents starting to flatline a little bit, and I think that'll probably be the case early in 2023 as you don't see the massive rent increases that you've seen in the last couple of years. Real estate markets in general have kind of ground to a halt. I think you have owners who have in-place debt at very low interest rates, and you have a buyer pool who would have to be coming in and putting much higher interest rate debt for acquisition financing. So there's just a bid-ask spread that only forced sellers or people who are incentivized to sell are really moving the market, or entering the market.
We don't see much of that forced selling at this point of the game. Some, but
not yet. We've started to hear, at least in the office space, right, the trickles are happening, right? You had, Brookfield defaulted on a couple of LA office buildings. I think Blackstone's handed back the keys. RXR has handed back the keys. So I think the office sector, because of the long lease runs, it doesn't happen immediately, but you're starting to see, the stress that's in the system, because you have what was a market with very low interest rates and as a result, low cap rates, which is a high multiple, right? They're able to go get high leverage debt. And, it doesn't take a massive move in cap rates for the equity to be underwater. And so I think you're starting to see that the office is where it's probably the hardest. Frankly, I think you're going to see it in multifamily at some point. I think the rent bumps over the last few years have covered it up. But if you see rents flatlined and you see expenses continue to run up on the operating side, I think you could see some more distress in just real estate at large.
And besides multifamily, what other kind of investments are you looking at that?
Hey, Ross, I've got two things. I'm gonna ask you to speak up a little bit more
Okay.
because you're probably very low voice,
Sure.
and also there's a couple
This way.
of questions. If you can, I think it's good to be interactive with this. We have Steve McCarthy.
Okay, sorry. Go right
I'm
ahead.
shy and retired, so thanks for pushing me. Yeah, quick question. I read that.
Can you please introduce yourself?
No.
It's too long.
Just because you are my personal friend, maybe
I
others
run
do
a
not
family
know
office
you.
in New York, and I've got 48 years experience in business. So, quick question. There was a comment in one of the recent pieces I read about the undersupply of multifamilies. Is there a geographic dispersion that you see that may make sense?
Yeah, I mean, that data's been out there for, years that we're
Right, right.
undersupplied
What-
in the US. I think that,
Where would you go?
I mean, I think right now what you're seeing though is that we have an all-time high of supply being delivered in 2023, right? So the low interest rates have made it that a lot of developers went into the ground all at the same time.
Yep.
And so I think that 2023, you could have just, and to your point, right, you can't move real estate, right? So if you go to certain markets, they built a bunch of units. If the unit supply is above what the demand is, now every apartment building in the market is competing, right? It's gonna, and the other thing is they all use the same rent pricing systems, right? So when the algorithm clicks the other way, they're all gonna be competing down for that same rent that doesn't exist. And so I think to your point, right, picking your markets is so important and really understanding the supply demand dynamics, or as the next 6 to 12 months, it's going to be invaluable to real estate.
So tier 2 cities like, in the Carolinas and Florida, whatever, those types of cities that are more as opposed to larger metropolitan areas.
Definitely starting to build up. I think Raleigh-Durham is our first market.
Mhm.
And as an example, we're on the single family side, but looking at inventory levels. The number of listings from last year is almost the same, but last year it was 5% new construction. Same week, it was 55% this year. So there's a lot of inventory starting to build up as builders start to move
Thanks.
it.
Appreciate it.
I am going to say at some point in time, I'd like you guys to discuss the politics of all of this shortage. Because I think there's steps government can take to build more building, right? So at some point, I know you're going to cover it, Ross, but I just want to reiterate.
I'm glad you know we're going to cover it.
I mean, and NIMBYism is what prevents it, right? Minneapolis passed that law. They got rid of single family zoning to encourage triplexes and different things, and then it got shut down, I think, by a local, environmental group. If I remember.
Really?
Yeah, I mean, so it's I guess the politics of real estate don't necessarily fall along the traditional party lines, right? Because the people you would think that would be pro development, pro keeping housing costs down, right? Like you have these cross currents of interests that kind of intersect. And the real blocker of all of this is people who own single family homes, right? They don't want new supply. They don't want their largest investment, right? The price to go down.
I mean, I guess in California, the rate is ADRs, right? Is adjacent.
EDUs.
ADUs, yeah. Accessory dwelling units. Yeah, so you've seen that in some markets they've started to do that, but that only solves a very small percentage of the general problem.
So you guys are alternative strategies. How do you make money doing stuff? And maybe there's some kind of a partnership. But you take it away, Ross.
Okay, Marty. Well, now that you mentioned it, I mean, one of the things that we wanted to talk about were some of the other areas that, are a little bit less traditional than multifamily or office to invest in. So some of the things that I think are interesting, like something, if you look at like the triple net lease retail sector where you're buying, basically you have a standalone CVS, a gas station with a 7-Eleven attached to a convenience store. It's a very robust, submarket that doesn't really get a lot of attention when people normally think about it. It's a relatively low yielding sector. Kind of low yielding being say, from 5 to 8%, depending on the type of tenant. But what's interesting about it is that it's a very low volatility sector. So we've had these big disruptions in the economy. These sectors have held up really, really well. And there's a huge market, not only an institutional market that's grown up around it, but there's a, you know, a retail, like a retail investor market. A lot of 1031 exchanges, for example, like to gravitate towards that product. And as long as you're picking the right tenants, the ones that aren't going to likely to go bankrupt, you know, and we've seen, you know, like some in the restaurant space, for example. It's been a great sector to invest. There are ways to get involved in it in the public markets as well. There are a couple of companies that, you know, trade on the exchanges that invest heavily in triple net, you know, lease credit investments. The biggest one is a company called Realty Income Trust, which is a multi-billion-dollar company. And I didn't check their yield, you know, the last couple of days, but it's something around 5% dividend yield, which is, you know, not bad. And you know, if you look at the stock price versus the volatility in the stock markets, it's held up remarkably well. And that's a place where one could invest today and be relatively insulated from the economic shocks that we see unless we go into a real disaster scenario. So that's one particular sector. Then there's another one I think that I know, Billy, I think you've looked at, which is real estate private credit. You know, as interest rates particularly have gone up, people need short-term credit to, you know, pay off one loan or renovate a property or something like that. Those are, you know, you get very high risk-adjusted yields by investing in them. If you invest smartly with good operators, good properties, you know, we've had an interest in doing that in residential here in New York. You could earn, you know, basically get floating rate protection and earn like SOFR plus 6, 7, 8% on your money, you know, unleveraged. And then if you leverage that, you get close to, you know, high teens, 20%.
Yeah, I mean, we started investing probably 6 years ago in a real estate credit strategy out of Baltimore. So they lend along the East Coast, and kind of the genesis of it was we were seeing, you know, 4 caps, you know, on the buy side, and I was like, why would I be the lowest person in the capital stack to get a 4% return when I could go lend at 10% and be, you know, the leverage through a 60 or 70% LTV. And the benefit is you can go to a bank and they'll give you 50% of the loan that you put out. And so since like the last 6 years, we've definitely been leaning into real estate credit just because, you know, the risk-adjusted returns are kind of out of whack with where the equity was trading. You know, as a family office, the tax treatment of, you know, interest from lending isn't as attractive as being the equity in a real estate deal. So that's something, you know, you have to look at the tax-adjusted return. But I think it's a great strategy if you find. I think the important thing that you mentioned was the right partner. So the partner we have, they're a developer, right? So we've had one default. We took the building back. We own it. They manage it. And in that workout scenario, we do even better. We get the tax loss the day we foreclose, and now we own it with cheap, you know, debt. We get the interest and the depreciation write-off. You know, when we sell it, we'll get to 1031 it, right? So effectively, you never really pay tax on it ever again. But that's the beauty of real estate, right? It's very tax advantaged. But I think there's a lot of real estate credit shops out there that are effectively originators that are then they're just warehousing that debt before they try to flip it. I think that's a very dangerous strategy. You saw people, I mean, when COVID happened, I think there are a lot of people with 30 to 60 day lines that got pulled. And so you saw them having to shop their books. I think there's enough dry powder on the side that there were very aggressive and attractive bids for their portfolios. But that's I think where the real estate credit strategy is riskier than it presents. I think on the triple net stuff, I think it's kind of the set it and forget it of real estate, right? You can kind of buy, you know, effectively a corporate bond with real estate upside. I think my inbox has gotten filled with a lot of Walgreens and CVS triple nets now that they're cutting back their store counts. So I think that's also another thing is you always have to ask why. Why is it for sale? What do they know that I don't know? But it's a great strategy.
Another type of tenant that's done well in that strategy is like the Dollar Generals of the world. They build about 1,000+ stores a year all over the country, and you know, and it's really weird. I've never really understood the Dollar General concept, and they are small stores and they're in very tertiary markets and very limited population, rural areas. Yet the company does remarkably well, and their stuff is not. You think everything's like $1, but it's not. I mean, there's almost no price advantage to what they sell versus anywhere else. really changed over time, but very popular in the triple net lease market.
Quick question on the real estate debt. When you look at loan to value on those, these are properties that people are buying, the existing properties that they're redoing the property, right?
Sometimes you do development as well. So yeah, it's it could either be they're buying it with some kind of value add strategy, so they're renovating, rehab, or just full ground up.
Yeah, popular use for that is construction or rehab, or in some cases you can do you can get for condo inventory loans. People have unsold condos and are looking to finance, those, and they have to refinance their own construction loan or something, give them more time to sell the units inventory that they have. But usually when you do that, you're getting a pretty big cushion on the spread in value.
It's a bridge loan, really.
Yeah.
And banks used to play in that space, but post the crisis, they kind of exited.
When they look at loan to value, do they look at completed value or? Okay, so
Yes.
that's a standard completed value rather than.
So
purchase
basically, you
value.
look at the completed value. You say, okay, I'm going to lend up to that. Their equity goes in first, and then as construction increases, your draws start coming in.
Right, okay.
Do you guys have any data on these trends in private debt? I mean, because it seems to me, as you said already, that there's, debt has been pretty cheap for years.
Right.
And then there's this huge chasm that you're gonna have to. So is it gonna be a slow trickle to that next level, or is it gonna be like a big jump? It's gonna be like a stair step? Because I think a lot of family officers want to know when to jump in, right?
Yeah, well, I'm not aware of any particular data that tracks it, but I think this sector has been around for, even when 0% interest rates, just the rate structure, the cost of capital is lower to do it. But there are a number of companies that
There's a
provide
gazillion intermediaries.
different types of capital. And, the thing about it is, again, I've always been a little bit perplexed by the demand for this kind of product because it's so expensive. Because when people are shopping around for the state, nobody really wants to pay 15% for low loan to value, debt when, the market should be a lot more efficient on that. So, but people need capital for everything. Sometimes they're getting a divorce, they're buying a house, they're buying a boat, whatever it is, they want to secure this asset. They have room to secure certain assets so they can do something else, start another business, invest in another company.
Ambition has no price.
And they think that they can, they'll worry about it in a year or 2 years. They think they have a plan to
Yep.
get out.
A lot of it's convenience. I've been surprised. You would think, right? Loans at this level of an interest rate, your borrower pool must have low credit, and the balance sheets of some of our borrowers is actually astounding, right? And that's the first question we ask is, why do you need this? Like, we can see you have money in an account somewhere, and it's convenience. They want to secure this asset, and
A lot of it's timing, right? I mean, as you
Yeah.
said, convenience, but I mean, people have goals and also, they don't want to have a failure. I mean, maybe Brookfield can fail.
Right.
But,
Well, and
Joe
it's,
Schmo and Texas.
And that's where reputation is important, both in terms of the capital provider and the party that's borrowing. But anyway, let's move on a little bit, not monopolize but this particular segment. Kamil, why don't you give us an introduction into what you're doing and what your definition of alternatives are, what's your sweet spot? Let's do it.
Thank you very much. I think yesterday a lot of the commercial real estate has been covered by Mr. Lewis, who is definitely an icon in New York, and I always enjoyed his discussions. I saw it online. We are a single family office. We are located in Dubai, and we are in the third generation. We focus on global investments, specifically on alternatives. We do alternatives 3 meals a day. We focus on commercial real estate, on renewable energy, on waste management, medical device, and I also invest in cybersecurity, and I invest also as opportunities arise in patents, where I bid on patents with different universities in the United States and elsewhere. Above that, I am an advocate of ESG, where I speak on different panels in different countries and in different locations, very much supportive of doing good and doing well. They go together, they are not mutually exclusive, and also on measurable impact on the investments. So I make that an overarching policy where I would turn down any investment, regardless of return, when the fund manager or a GP kind of push aside the conversation of the ESG and the environment. And that for me is a code of ethics that's not going to change. Now, talking about alternatives today, I wanted to match the Gen Z, what here in America you call, for some of the youngsters. And I asked Chat GPT, what is alternatives? And gave me a few bullets I'd like to share with you and the audience alike. It says that alternative investments are a narrow specializations of the investment management. And it says it's relatively low correlation of returns with those of traditional investments. I don't know why alternatives are called alternatives, or they are traditional. They've been in the trade for many, many years, way before stock markets was a word in the vocabulary. So not only in defense of it, but also in the importance of it. Listening to the doctor earlier, I am going to invest into the basic ingredients of what he wants to put in his machines because they are not made in the USA. He bring them from China. So if one administration make China an enemy and shoot balloons and whatever they're doing, we noticed that beginning of COVID, we didn't have ventilators. They came from China. And we did not have antibiotics because every antibiotic in the United States is made in China. And when India liked to replicate China, they buy the basic ingredients from China. So for that, I think I wish that the doctor would be invited again, and we will have more time, like the gentleman here, raise more questions. And not because we refuted his research and development. I admire that. But again, we are business people, and we are about investing and return and protecting our interests. So I like to give my colleague also an opportunity because he did not have an alternative. So go ahead.
Did you ever ask, did you have any comment
I'm
there?
challenging
Before we go?
Russ, he's our friend.
Well, before we let you go, Kamil, tell us about what alternatives in real estate mean to you or to your investment program.
We only own, we have a substantial portfolio here in the United States. But for multifamily, I only have 2 assets in Tampa, and they are gated communities. We bought them from the same sponsor. 2018, they were just brand new and just opening, total close to 1,500 units. And that's all I have. I don't like to be a landlord. I don't have a management company when I acquire any of the GPs, which is something I do sometimes when they propose an early exit. And I see that the investment is still making money with a good cash flow. There were a few incidents where I bought them out. Let them get their carry, let them get whatever fees that they had been expecting and maintain it. At that point, I will hire a third-party waste management, a property management, I'm sorry. Commercial real estate portfolios is, in answer to your question, life science centers, data centers, and self-storage. Those are definitely a recession and inflation proof. And the demand on them has been great during COVID and post-COVID. And also the occupancy has been an optimum. And you didn't have to build to jump in the pool of Miami and South Florida and the other destinations that I see everyone in the multifamily jumping on. I still believe that a recession will not be soft landing. Everybody is now becoming into the aviation world, soft landing, hard landing. I mean, I have a pilot license, so I can do that. So I don't think it's going to be a soft landing. There is a lot of cover up with the war that is going on. I am very much deep into macroeconomics. That's my education and practice. And also, if you are into global investments, allocating capital in different countries, if you don't know the politics of that particular destination and the tax incentives, how are you going to allocate capital? So seeing the world, I will close here. Seeing what's happening in the world, there are a lot of cover up for what the economy here and this volatility should expect, not being a doom and gloom. But look, in economics, there are fundamentals. You can go around them and use different theories, but you go back to core. And core say, when you print so much money, up to $33 trillion, there has to be a price for that. Yeah. So you can use the modern monetary policy theory as long as you want, but there will be a price to pay. More to be maybe in a future panel What do you say, Marty?
I think we covered MMT in the past, but yeah, it's crazy. But I had a question about, so you talked about multifamily, and obviously there's a lot of gated communities that went up, and they're still going up, and guys who were in workforce housing, they plowed into upscale multifamily, right? Like, and they did Miami, right? Or like, I think Rich Richmond did a huge project out in Kendall, right? What about workforce housing? Is there any future in that, or any thoughts on that, or?
But maybe I can answer by asking everyone here and online. Do you believe that the unemployment is 3%?
No.
No. Well, what definition?
More no?
But unemployment is just a
You know what I mean?
calculation that the Bureau of Labor
For
Statistics
the
it's like-
future, well, for whatever, no, that has been adjusted since the administration of Barack Obama many times, and we all know about the inflation rate and all that stuff. I do not trust that I can buy more data and hire more third-party data providers so I can do my final decisions based not what I hear from managers and sponsors, but what I hear from their analysts, because relative value doesn't come from the manager. Relative value comes from the analyst, as we all know. So we all business people and we all investors. We are not here about just making everything look like the New York, what is that? New York Times,
Wall
was
Street
it?
Journal,
Washington Journal, all of them.
Wall Street.
Wall Street, all of them.
I mean, the U6 is probably significantly higher than 3.8.
Say that again, please.
U6, unemployment 6, different calculations, significantly higher than 3.8. And another thing that's happened post-COVID is the amount of people 55 and over have left the workforce significantly downsized.
So it's
different that way.
But that's always been the definition of unemployment,
No,
right? The denominator of unemployment is people who are in the labor
No,
force.
no.
Right?
So
If you
Marty,
leave the labor force,
let me
it's always been
answer
the
Marty,
definition.
please. So Marty, in answer to your
Yeah.
question,
Yes, but
I am concerned about, when it comes to multifamily, I'm concerned about the outcome. And that's why I find it to become a higher volatility. I'm not saying that Miami is going to shut down or Houston or any of those, but I'm saying that all that is high risk. Don't forget, when I say that I am a single family office, I am fully aware of my risk tolerance and how much money I'm willing to lose while I'm keeping my smile.
So
You know, that's my definition.
You think we're going to have a correction in the real estate market in the US? That's what you think?
It is coming on the way. Colleague. your
Yeah,
turn.
that's a good
All right,
intro.
well, let's move on. Thank you, Camille.
Sure. One more
I
question.
mean,
What do you think about the real estate market in the Middle East? In Dubai was just out there last week. They're still building like crazy. What do you think about that?
And you mean valuation for it?
Valuation or the worries that you're worried about the not so soft landing in the West? What about the Middle East?
Look, we do have a blessing under our ground. As long we are drilling it and you are buying it, we are
Everything's good.
We're good.
and you are driving it. We refine. Now we're selling it refined. And now all our administration saying that you want our money, come and invest in our countries. And that's starting from the Prince of Saudi Arabia. Said, look, if your company does not have your headquarters in my country, I'm not going to give you a contract. I think this is unbelievable. Talk about disruption, that's disruption. But the demand over there is because we don't have taxing like you have here, and we don't have to worry about short-term income, long-term income, and trusts. I'm listening to an attorney yesterday. We were addressing Fordham University on the same topic yesterday in the afternoon. And my colleague was a tax attorney from a reputable company, or reputable firm, to be correct. The amount of taxes that is being paid make people come to us. I mean, we have single families coming from Europe, from Singapore, from Australia, from the United States with their team, buying mansions, buying more properties for their staff. They're bringing their staffing with them, not because we cannot staff them, because our staff are all expats. We bring them from other countries. But they coming, spending millions of dollars to have their business there for many reasons, for security, for social disruptions that are happening in the West. If it is Europe with their unnecessary war, and here in the States, we becoming the hub. I mean, today, if you ask me, and I'm comfortable to say that the largest dry powder in the world is in our banking over there. That's why everybody say, Kamil, can you help me raise capital in the Middle East? I say, it all depends on what you're offering. I hope that answers your question. Thank you.
We need to move, thank you.
Absolutely.
We need to move on to Mike. Mike's got a very interesting story. Mike, as a CEO and co-founder of Acre Homes, the serial entrepreneur, started and sold other businesses in the real estate space. And he's involved with a new company called Acre Homes, which has been developing for the last couple of years. Acre has created a new model to invest in single-family homes. As I said before, it's kind of a value share. Residents contribute 5% of the home's value and have an ownership mentality, very higher quality demographic than most single-family rental home models. And turn it over to Mike.
Yeah, we're maybe not as alternative as some of the other strategies up here, but I think part of why we're here is that there is I think single family is really starting to institutionalize and continuing to grow, and we have a very unique play on that I think is working in this market. I think that's part of why we're here. A lot of it comes down to actually what Peter Lewis was talking about yesterday, a couple of the trends in terms of ownership perspectives versus rental, and people shifting into ownership, shifting into rental. What is that going to look like in this new world? And what we've actually found is that there is a huge segment of the population in between where the tenure has come down on owning homes to 3 to 5 years. So when people sell their homes, 29% of them have lived in there for less than 5 years. So if you add up all the transaction costs and the carrying costs of getting a mortgage, we're actually able to provide them a better experience and a lower cost than getting a mortgage, and still give them, to Ross's point, some of the benefits of ownership. So what we're doing is we're targeting growing markets where there are great tailwinds on single family and home price appreciation, where we go in and we buy the home alongside the resident, and they contribute 5% of the home's value into a value share, but it's just contractual. So we hold all the assets so we can still securitize and scale up. But what they get is they don't have to deal with the bank. They don't have to get a loan. They don't have to pay transaction costs on either side, but they're still sharing in the appreciation. And what that does from an investment perspective is it aligns the interests and it cuts out a lot of the challenges that single family have had. I think, multifamily and some of these others, we focus on the density. What we're able to do is, because they have the alignment in interests, as compared to the large single family operators, they're covering the day-to-day maintenance. To Ross's point, our average customers are buying, $500,000 to $900,000 homes in the Southeast. They could get a mortgage, so we're not solving the affordability challenge, but this is a better way for them to access that home, given they know they're going to leave in 3 to 5 years. So it cuts down on the maintenance by 25 to 30% because they're paying for the day-to-day. They love the fact that instead of the way they owned their home before and had to handle all the maintenance, they now have a phone number to call, and we can dispatch that, but they're paying for it. So it cuts down the cost there. And then we have recourse on that 5%. So the other place single family often loses is when people damage the home, and that goes into their turn costs. And so the aligned interest creates a way where they're looking to maximize their trade-in value and get the most out of the home when they move on, or when they cash out, or when they trade to another Acre home. And so we're able to cut it, make sure that we can protect our yields. So when we talk about why are we up here today, what's working today, most of the single family, and it's been fun working with some of these larger operators, have ground to a halt because they're looking at negative spreads on their debt because they're buying at 3 to 5% cap rates. And our customer is comparing our product to a fully loaded mortgage. So as rates have gone up, our effective rents have gone up, and we're buying at 7 and 8 caps right now on phenomenal assets. Yeah.
And are these all kind of community-based developments and order to buy their home at some point, or is that?
Yeah, we tested a lot of this since you're creating this new concept of this new way to own your home or own part of your home. We tested that out. We found that customers really wanted two things. They wanted a fixed payment, so we fix it for 3 years, and then we mark to market every year after that for a couple more years. And they also really value the option to buy it. So we get a lot of people who they're just not sure. And if you're not sure you're going to be there for a long term, they acre the home for a few years, and then they have the option to buy it at the market price that it's at. Good question. Yeah.
Segueing briefly, they talked here about the widening gap between sectoral winners and losers. And I'm looking at a chart that says sector divergence, returns, and volatility put together by a firm named BlackRock. Everybody's on the panel has talked about real estate in terms of residential, some retail, some hotel and office. The Northeast quadrant with the highest volatility and the highest returns is industrial. Comment, please.
Comment on industrial?
Yes.
Well, Pete, I'm not an expert on industrial. I have had experience with it in the past, but not in the latest iteration. But it's been a very popular sector with the growth of warehouses, for companies like Amazon and others that need to get delivery out to the customer. All the online retail ordering, stuff like that. And then, technology enabled supply chain stuff. It's been a very popular sector. It's maybe, now that Amazon in particular has pulled back and some other companies have pulled back and are kind of retrenching, may go into a period of slowdown.
Isn't there a lot of cyclicality in industrial? And number one, number two, wasn't it overbuilt like in the 90s and 2000s? What was that, exit 7 and 8 in New Jersey, the Garden State Market, whatever, right? I mean,
Prologis stock is down. Prologis, which is the 900-pound gorilla, their stock is down.
And also like what Pete said yesterday was that even though he's bought a lot of industrial, it has to be a certain type of industrial that will fit robots into it, right?
Right.
I mean, any thoughts on that?
I mean, the last 5 years, industrial development across the United States has been massive, right? Amazon and every other
We're
business
old.
needs a
This
massive
is like a shorter horizon, but anyway.
needs a massive distribution center, right? So like, for example, 18 months ago, we invested in a probably 2 million square foot industrial development in Phoenix. And we put a shovel in the ground, and an insurance company came to us without a tenant in place, without the building constructed, and wanted to put it under contract with a hard deposit, assuming, I would say somewhat aggressive terms, right? So I think there is no shortage of capital that wants to invest in industrial because people see Amazon and every other business needing massive distribution centers to move their product.
Would it be institutional capital or family office?
This is the biggest pension insurance companies.
Right, I'm saying institutional corporate.
Yeah, are putting money in, and there's developments across the country. To your point, that central New Jersey industrial market, if you've driven the New Jersey Turnpike over the last 10, 15 years, the sides of the highway have changed dramatically. It used to just be trees, and now you drive down there and there's a distribution center. If you go out to the Allentown, Bethlehem, Easton market, right? They have.
Do I have to?
No,
Since you asked, you have to.
Like Bethlehem, right? The Steel closed, right? They put a casino in there, but if you get off at that same exit today where the Steel used to be, there's millions of square foot of industrial space because it's well located to most of the northeastern United States.
So it's regional. If you go to South Carolina as an example.
South Carolina, there's a ton of it.
It's a very, very friendly state. So depending on the state you go to and the region you go to, the building plants and distributions and car assembly things and everything across the board.
Yeah.
I think Port of Charleston is like the third largest port in the country, right? So-
The problem that you're seeing though is that people got very aggressive with cap rates, right? I think real estate writ large is an interest rate game. Yeah, right. So the higher interest rates have marked to market people's portfolios down dramatically. Sponsors aren't marketing it to market as accurately aggressively as they should. And they're just going to hold, that's why, every real estate conference I go to, everyone's like, well, interest rates are coming right back
They're
down.
coming back.
It's going to be great.
Right.
And everyone's just talking their book.
I think that's a great point. I know nothing about the industrial, but on the single family side, which we know very, very well, I think that is the key point, is that it is regional, right?
Yeah.
When wherever you're making your bet, and that's where we focus. Picking the right market is so much more important in our game. And I think Peter Lewis talked about this before. So if you're playing in single family, there are tremendous tailwinds and shortage of supply in some markets, and you're going to see 6 to 8% appreciation over the next 5 to 10 years, and others you're going to see 2% or negative. So it's all market.
The smile economy, right?
The smile. That's
And
right.
you just look at, where people are, look at the trends of where people are moving out of states, and, people are leaving New York, they live in New Jersey, they live in Illinois.
Yep.
They live in California, and
That's why you
they
have to
live in
throw out the 4% home price appreciation. That doesn't exist. It's market by market, right? You're gonna have
Everybody's going off.
And they're moving to Texas, and they're moving to Florida, and they're moving to North Carolina and South Carolina. And
I'd like to answer Marty on his question also.
That'd be great.
And stay on industrial, because in distribution that everybody is mentioning, immediately they throw Jeff Bezos in the center. As if Amazon is the only element that is keeping the industrial sector alive. This is not about a cap rate or about return, because when you own industrial, you are a long hold. And the tenancy is very important. Single tenant industrial always make you, as a principal, a subject to be dictated to by the Amazon and the like, which is something for me that I definitely avoid. And if someone says to me, would you turn down on any of your assets when asked by the management on a lease from Amazon? I say yes. Why? It's because I don't want someone, a negotiator to dictate the price per square foot 30-40% below that particular market, decide the term of the lease, the bumps of the lease, and the exits as he wishes of the lease. That does not protect my interest into industrial. So industrial today, you have many different economic sectors that can be your potential tenants. If you are in Boston area, you have a lot of medical research, and you have especially, and also I have industrial portfolios in opportunity zone, close to major cities, like in Atlanta, where your tenants are new businesses, new startups, and companies that moved from the north. The gentleman who asked about the Northeast, my lifetime friend, I think it's temporary. The Northeast and other states, because of their taxation and because of social unrest in them, I can see a lot of companies moving away, including central New Jersey and everything on the highway that changed color. And more has been built, and I agree. And I've been to Easton, Bethlehem, and Allentown several times to the airport, because we fly private jets, not to the casino. I see you laughing here, Marty. But there is growth and there is demand, but it's all about the investor look for taxation, for security, and also for a full occupancy.
So, Kamil, the family office is concerned about taxation. Hence, the industrial side, where you look at that, is going to be institutional money, tax-exempt money, pension funds, corporate entities, and whatnot that like that. And the return profile shows 18% return, and 7 or 8 standard deviation over the last 5 years. So that's a natural buyer of some of these things that Billy and you and he are saying.
Right. But don't forget, they made a lot of acquisition when the interest rate was low,
Yes.
and they're going to pay the price sooner or later. When those notes reach maturity, there will be another thought. They bought homes, thousands blocks of homes in Phoenix, Arizona, and in Scottsdale, and in Houston, and elsewhere. Analysts sitting, we're buying 25 zip codes, and they never saw those houses, and they charged accordingly. You talked about the mark to market, which is a great term. I heard it a lot during 2008, 2009. We all did, but moving forward, there will be a change.
Well,
there will be a change. Even
when,
those
when interest rates are low, everybody's a Tina investor. There is no alternative.
I think the other, just because industrial, right? I think the CHIPS Act, I've already started to see the areas that they've identified as the hubs of, so Phoenix, I think Columbus is another one. You've already started to see industrial developers looking for sites around there, right? Because effectively you're going to create an ecosystem. There's going to be the actual plant, but there's all the people around that need to service the plant. So I think that's another industrial development in the opportunity.
Hi, when the topic became alternative, real estate strategies, I thought you were going to touch more on the opportunity zone idea. I know, Billy, you talked about 1031 exchanges, and Camille, I was surprised that you were interested in opportunity zone, but it does fit your ESG concept.
Definitely. Well, just not for boasting, I was among those group that were advisors to Senator Tim Scott when he was developing this starting in 2015. And it did not reach that readiness until close to right after the election of 2016, where he brought Senator Booker together, so to be from both sides of the Congress, to present it to the administration of Donald Trump. So I've been with him, and actually right now I'm working with him for your comfort on something new, not only myself, with others, on bringing a new legislation to the Congress that support incentives for vocational schools. Because United States is short on vocational schools. Good for real estate, good for the community, good for couples that lost one income or two and cannot afford the regular rent or the mortgage that has been existing. That's what I talk about in the future. That's where we have to, as leaders, plan for tomorrow. Not only today, internal rate of return and cap rate and other 36 ratios that we all learned in school, that is not going to do good for those people who lost their jobs.
Is there going to
So-
be an extension or a new form of the Opportunity Zone Act? I mean, because I think it expired.
There will be an extension, to encourage people to sell. Because how could you sell today if there is no relative value? I mean, regardless who is the company, is it institution or it is an insurance company or family office or otherwise, there is no relative value in the market. Someone asked me in Miami when we were 2 weeks ago in that economic forum, and Kamil, what did you buy in 2022? I gave them this. I said, nothing. I said, I'm focusing more on renewable energy right now because I see more in development and more incentives going in that direction. So we invest with companies, startups and otherwise. But on real estate, there is no valuation. And for those of you who are buying, I'd like to learn from you.
There's about 10 minutes.
To your question about opportunity zones, just to
Yes.
circle back, we've done 2 opportunity zone deals. I think for those who don't know, right, opportunity zone basically could take a capital gain for 1 year, you have 380 days to roll it into an investment. There's opportunity zones every state designated, the census designated areas. And so what we found was the legislation got passed, and then basically pieces of land within opportunity zones, the price skyrocketed. Yep. Right. So even if you had the capital gain and the tax setup was great, it was effectively a wash now because you're going to pay more for the land. Right. So it was effectively passing that bill was a handout to people who happen to own land in these opportunity zones. The only ones that we did were people who had already had land under contract to close before the legislation passed. So now those deals are home runs because you had the basis pre-legislation and you got all the tax benefits.
I must add also that there is a social side to the Opportunity Zone Act. There are 52 million people who live in those 7,862 zones that were designated by respective governors of the 50 states and 5 territories. Those 52 million people, it took time until there was a discussion at the Marriott in Brooklyn, and my counterpart was Secretary Ben Carson, where I told him, I said, Senator, doctor, I said, you are great. You separated the conjoined children. I said, but when we're talking about this, so we are not talking about 52 million people that live inside them. There is a lot of gentrification that could take place. We need further amendments and further additions to that legislation. And there aren't enough schools, there aren't enough medical centers for women to go for mammogram, for delivery, obstetricians, whatever the case might be. Kids take a bicycle to go from one village to the other. You might not see this in New York, in Queens, in Brooklyn, Staten Island, but it is in Mississippi that the doctor mentioned before. And it is in Arkansas, and it is in Louisiana and many other states where people live below poverty. That means below $18,000 a year taxable income. So the opportunity zone has 2 sides. There is the finance side. There is the opportunity for the real estate people, and I am one of them, but also there is also consideration for the social aspect of it that we must not look the other way when we talk about it.
Some of that's tax policy.
Sure.
Right. Sure.
That I don't know. I mean, 5 and 10% of a step up, that is not going to give the people who live there any advantage if you are building something they cannot afford. So what happens? People told them raise the prices, the community leaders, and that's where all that demand. And now they are moving to other states if they can afford. So this is a longer discussion. But thank you anyway.
We have 5 more minutes. One more question?
I brought this up yesterday. Does the panel know of any pooled vehicle that would allow for people to invest in a trend that I think is very attractive, and that is, I brought it up yesterday, where retirement facilities are put up on campuses, where there's a massive retirement issue going on. I mean, baby boomers like myself, I'm in the vanguard, maybe, but they're aging and then they're approaching retirement age.
Lifetime university living, right?
So that the idea is to put up a condo or a rental unit, paying land rent, what have you, to the campus. They order classes, they can go to sports events, they can be amongst young people, they can be tutors, they can be babysitters, right? And they will endow they will put their, their wills into the endowment if they're living a splendid life on a campus rather than a desultory, retirement home in South Florida. So, and just looking at old people everywhere. So the idea of these retirement facilities on a campus is very attractive to me, for all kinds of similarities.
Do these actually
you
exist?
know of
Do these
any
actually
schools
exist?
Does anyone
There's
know?
a few.
Yeah.
I guess
I
I haven't
know-
heard of it.
You know of
It's a thing
any?
that's been around for a while.
Can I answer your question? In our inner discussions, that when we sit with legislators and also with investors and with economists, most of the pushback came back from the endowment managers and also from the schools themselves. For them, when I talked about vocational school, they wanted to know immediately who's going to pay the tuition. They are not will. I said the classroom is available, and we will also work with you to have those classes for the vocational program, whatever it is, in what state, at times when your classrooms are not occupied. No. We do have an operating budget, and we must always keep our. I said, all of you have endowments in the billions. I said, this is done for the country. But I guess people love the country only at baseball when they go like this.
I don't.
Football too.
When you say campus, are you talking about co-locating the senior housing with an existing
With an
university,
existing
or
That's what he
or
said.
donating
There's
new
one in
land
Sweeney
to
Purchase.
develop?
No, that's what he said.
A lot of campuses have spare land.
Yeah.
especially
A lot of
the
spare
rural
land.
ones.
Sure.
And those, the bucolic rural campuses are where people want to live. There's a intellectual life, there's a entertainment, there is a opportunity. And very often there's good medical facilities nearby as well.
Sure, there's a
John,
So
so there's a
so
birth
this-
dearth though, right? And so they're expecting a lot of campuses to shut down in the next 10, 20 years. A lot of universities.
And
to
so
shut
it's
down.
well, I mean, and this so the is- supply of stock. This could ameliorate their budgets, because I mean, people who are living there and ordering classes are gonna pay for that. Or they're gonna pay land rent if they've got a condo.
It's definitely an alternative.
No,
I think it's
I've
a-
got
I think
two
great
kids in
alternative
college right now, and I'm a little bit cynical about all this. I don't see the universities generally having something like that fit into their business model, because they're more focused on, like you said, tuition. I think they view students as basically, renters in effect. They're not part of the long-term constituency of the school, except if they're donors, for long-term. And, the constituencies for the universities really are full-time employees of the universities.
Yeah, I
So
mean,
2
they-
points, 2
they've
points. One,
They've essentially privatized dormitories, right? So that's why you have student housing, which is all private private.
yes,
real
it's a
estate.
form of that, So but I John- mean, it's also
But-
longer term.
We've got a lot of questions and we got it.
And
Yeah.
these people become donors. So
John,
you SUNY become an Purchase- alumnus of the school. SUNY Purchase SUNY Purchase up in New York State University of New York Purchase has exactly that. They built the program there. Number two, regarding the rural communities, they don't have Harvard money. They have, if you take a look in the Cuba, 758 colleges is about maybe under 100 out of $1 billion. All the small schools that have maybe 50 to 100 to 200, $300 million in those boonies that are attractive really rely on student income and tuition. They don't have the money coming falling off that. So that's another issue.
Well, I guess also does the universities have teaching hospitals, right? If you think about it,
Some
right?
of them do, but I mean, if they're not an actual medical school, they may have what's called a green book hospital nearby, which is a facility for a distant medical school to send their students.
I'm gonna suggest we table this. We've got 2 more
But
questions.
they'll have student
And we only have
services,
2
which are
minutes.
better than.
So-
I'd like to say to the gentleman, I support what you said, and if you're gonna lobby this, count on me. I share with you my contacts. I am on your side.
It's the
Yeah.
nichiest,
Just real quick on that,
Yeah.
if I may, to the panel, this whole multi-generational housing concept, and know the Pepsi was to be talking a lot about that. I mean, is that kind of really gaining, I mean, academically, it makes a lot of sense that there are houses with.
As a family office, we are experiencing this internally right now because, when I was growing up, because my dad was at the end of his life. My dad was the patriarch, and then myself, and now my children. But today, because of the extended life expectancy, most families are having 4 generations alive. So the demand is there and the taste vary, and the demand vary. Today, I'm sure if I don't have any children in their 20s, but yesterday at Fordham University, due to the line of questioning that came up, what I told them, I said, you guys sound like if I take the refrigerator out of the house, you are okay as long as you have the Wi-Fi. Because they will not be able to survive without
We've had
the toy.
generational stuff forever. It's called Lower East Side tenant houses.
Well,
Think about
I
that.
think it's a good, I think it's a really good point just in terms of how real estate needs are changing in general. And we saw, you know, obviously the COVID shift, we've merged the office and the home as well. And I think that's part of what our model really taps into is that people are looking for more flexibility, right? Because to Billy's point, they're locked in on interest rates and they need to make a move because they need to have their office and house or having another kid. And I think that is one of the other trends is multi-generational. We're also seeing a lot of 50 plus folks that just want to be close to their grandkids, et cetera. And so they're looking for more flexible options than just a traditional mortgage.
Time for one more question. Anything out there or just closing statements? Let's do closing statements. What's your best idea for the next year?
Concentrate on recession-proof assets if you want to talk real estate. I'll stop here.
Okay, good.
I think Kamil had the point of a lot of people are frozen right now. And we see a lot of shortage in single family and we can currently buy them at great cap rates where we have positive spreads and we're focused on areas where there's high growth. So I think there are ways to play really thoughtfully in I think one of the emerging spaces in single family, and that's where we're laser focused in building a fund.
Yeah, I think two things for me are outdoor industrial parking is actually a very interesting alternative real estate play. A lot of cities, right, more trucks are delivering things and they need to be parked somewhere close to the urban center. And it's interesting kind of land banking play if you get a good current return and from the development side. The second is I think at some point next 12 to 24 months, the office situation is going to get oversold. Maybe I'm a Luddite, but I think people will go back to the office 3 days a week. And if you cross into that third day, two people can't share the same space, right? So I think that employers will cut square footage, but they'll probably pay more per square foot for the good buildings and the good sites. And so I think at some point there'll be an opportunity there. We haven't gotten there yet, though.
I find interesting Mike's Acre Homes model, not just for this current year, but for something to, you know, look out into the future as a good growth opportunity. That'll be very interesting. And, you know, for the short term, I like the real estate private credit opportunities. I like anything that's got current high yield, cushion on, you know, valuation, which the credit does. And that includes both private deals and also some opportunities in the public market spaces. Where good, safe dividends, mortgage REIT area selectively.
Ross, great panel. I'm glad you suggested it. Great job.